Merry Christmas, everyone. Welcome back to another episode of the Market Radar podcast. As you can see here, the year to date updates on the indices are looking grim into the end of the year. It doesn't look like any of these are going to head into positive territory, which just under a month ago was the idea that we were going to get a Santa rally, but that has since evaporated. Let's go over the matrix, the regime matrix. So we're still in stagflation with over a 50% chance of risk off. So the risk off is holding strong. We're not seeing that buck trend just yet. So we are still waiting for an Aries trigger, but that can come at any point. So we always have to be prepared. When it does, we're going to go in with size and strike hard. Let's go over the economic calendar for the week.
So next week, it's fairly slow. It's Christmas time, New Year's time. We're not expecting any crazy moves in the market, probably very similar to this past week. The main days to look forward to are Thursday and Friday for jobless claims and Chicago PMI. So keep an eye out for those.
Okay, and let's go over the GDP release this last week. This was the big release of the week. Everyone was talking about it. We came in at 3.2% quarter over quarter. The estimates were for 2.9, so we came in above estimates, and the prior reading was negative 60 basis points. Now, obviously, one would expect a higher than expected GDP print would yield better market returns or higher higher more gains in the market, right? But that's not what happened. Obviously, the market printed lower on this print, and we did forecast this in the prior video that came out before the GDP release. We said that the odds were that GDP would come in line and market would sell off. Obviously, GDP did not come in line; it came in above estimates, but market did still sell off. Reason being is simple, right? This is seen as a double whammy, right? We have a nice print, more growth, but we're in that situation where the good news is bad news. So obviously, stronger growth is just an indication the Fed has to do more, right? Because the Fed's looking for a recession, which doesn't occur in above consensus GDP printing environments. So because GDP printed stronger, right? We saw the terminals slowly lift, and we just saw the market selling off because again, it's the idea that the Fed's going to have to do more is becoming more and more relevant, and that just means that bond prices are going to go up. Bond rates are going to go up. Bond prices are going to go down. Terminals are going to lift. Real yields are going to go higher, and market's going to remain pretty shitty. And that's just what we had emphasized in this GDP report and into the end of the week last week.
Yeah, and that's exactly what we saw across bond markets last week as well.
Yeah, we had ES here on the GDP print trade lower, come back up, do nothing on Friday. All in all, closed down 1.28% for the week. And then obviously earlier this month, we had the CPI print, which sent markets higher and then ultimately lower thereafter. So the two big economic releases for the month have pushed markets lower, all being obviously better than expected, right? So we had CPI come in lower, GDP come in higher, and markets still shit the bed. So that's obviously something that we have to pay attention to. Good news is bad news. Now, let's go over bonds. This again harping on the fact that we have told everyone that this is a counter trend move since it started, right? The odds have always been within a bearish trend that moves higher are counter trend moves, right? When you're in a bearish trend, no matter what it is, if it's bonds, SPY, or even Bitcoin, right? Moves that go against the trend are counter trend by definition. Now, if they are counter trend by definition, well, the trend should resume at some point unless the trend changes, right? So the counter trend move we saw here in bonds is now reverting back lower into the bearish trend that has existed here for a while. And a lot of people see a move like this off the lows or a move like we saw in the last month off the lows, and they get this idea that maybe rates have peaked, inflation has peaked, time to chase bonds. But they again forget the big concern in markets is the good news is bad news, higher for longer environment. And the higher for longer environment simply is the Fed's going to have to hold the rates higher for a longer period of time. Now, I've spoken about this a lot. I'll say it again. It's not the face value of the nominal rate or the nominal Fed funds rate that's the issue, right? That it's not 4%, 5%, 6%. It's not like the Fed's going to go to 7%, or let's just say the Fed were to go to 8% or any of these higher arbitrary percentages and the market's just going to break. That's not how this works, right? The destruction comes from the duration of which those rates are being held at those levels. So, simply put, if you lift the rate to 4% for 24 months, you're going to do exponentially more damage than lifting the rate to 10 or 15% for 1 month. And that's what the issue that we're facing here right now is that the Fed can move the rate, has the intentions to move the rate up to 4% now for at least over a year. And that's not something we've seen in a very long time. And that's going to be very restrictive on the economy because what ends up happening is debt rolls off, right? And has to be refinanced. So when that debt is refinanced it's going to have to be refinanced at a higher rate. And a lot of corporations, again, these entities aren't stupid. When rates were zero, right? When Fed dropped rates down to zero, they did as much financing as they could. Why do you think everyone was running wild? Money was flush, flooding the markets. Everyone was flush with cash for this reason. Everyone knew to refi your home when rates were at zero. Everyone knew that that was the time you wanted to take out big loans at cheap prices, right? That's what was happening. And when the time comes for those loans to be rolled out and refinanced, you're going to have an issue, which is why the home crisis is a pending issue, right? Because it's the idea that the longer rates stay up, the more duration there is for someone to sell their home. Meaning, like if you want to sell your home, right, and the longer rates are up, the more and more people you're going to catch in that environment that want to sell their home. And simply put, if rates were to go from 2 to 6% mortgage wise, right, and drop within 2 months, the amount of people you would catch trying to sell their home in a 6% environment would be very little. But imagine that rate sitting at 6 months for 2 years or a year. The amount of people that are going to be forced to sell their home and the amount of people that are going to have to buy homes in that environment is going to push prices down. And we're just seeing that. We saw that this week with the existing home sales continuing to fall off a cliff. And it's just that's going to continue to happen until we get inflation under control and the Fed can really break their hold in rates. Now, again, a lot of people with the bond trade are very, very confused because they think that when the Fed pivots, they're going to go straight to zero, right? Obviously, we don't see a pivot like that happening at least in the next 12 months. So when you're buying bonds right now, if you're buying bonds, you have to understand that you're buying bonds purely for the coupon. You have to throw appreciation out the window at this point in time. Obviously, there's still bearish trends, so the appreciation isn't going to be there yet. So if you're chasing bonds, just do it knowing you're chasing coupons at this point. There's no longing TMF and catching like a 50% move. That's not happening yet. So if you're buying them, and TMF is not something you buy for a coupon. That thing yields 1.5% and has negative carry. So like this is, you're buying this for a coupon payment. You need to go back to your security analysis textbooks. That's some bullshit. You got to just buy TLT.
Yeah. So
Yeah.
essentially, medium to long term forecast on bonds is remaining to be chop between
Right.
the range of the lows and Momo.
Right.
That's the likely outcome.
That is the likely outcome. And let's talk about quickly over liquidity and what's been going on here. So I haven't spoken about this index in podcast for a while, and I think it's important we go over it to give some context behind the daily tweets. Again, this is posted daily to our Twitter, where we indicate what the current price is, where VIX is, so on and so forth. So what this index is simply is a measurement of liquidity conditions or liquidity risk in the market. The higher this goes, the more liquidity risk there is in the markets. Okay. Now, historically, this has traded very well with VIX, meaning as liquidity risk rises, VIX follows in suit. We've seen a huge disconnect here in the last year or so, and that's primarily due to things like the reverse repo, dollar demand, and a bunch of other factors that are really anchoring liquidity risk above VIX. And the big implication here in this whole problem is the direction of which of these are going to break, right? Are we going to see the liquidity risk break lower or VIX break higher and then resync at some point? And you can see on the chart here, there's a line at 70. And this is the risk pivot. Going back in time, this is not a mathematical number. Okay, this is more visual than the obviously the liquidity risk index is math, but this red line is more of a visual point where Once prices, or excuse me, the liquidity risk index gets above this risk pivot of 70, historically, risk assets have done very poorly. So it's very likely that we're going to have to see the liquidity index get back under the risk pivot to really see a solid bull market emerge in risk assets like SPY, NASDAQ, so on and so forth. So until that happens, obviously, VIX has upside risk. There's tail risk that, again, VIX is sitting at above 20. So any day now, VIX can go to 30, no problem. And that's a big move for markets. So just pay attention to where liquidity risk is. And if it's not under 70, just know that equities, specifically risk assets, can have a lot of difficulty in this environment. Whereas a move down in the liquidity risk index is not necessarily bad for bonds, right? If this wants to break lower and head towards the risk pivot, risk assets might not be a trade at this point, but bonds could be the long into that pivot, if that makes sense. Bonds could be the long on the move of liquidity risk from here into the pivot, and then from the pivot we get long risk assets. That would be the deflationary move back into a risk on expansionary regime. That's not something we're obviously seeing at the moment, but it's just something to put out there and really digest and understand that bonds will likely be a play before equities. That's what I'm trying to say. Simply put, bonds will likely lead the move, and then equities will follow. Now, this brings us to the last segment here.
I just have a quick question. What do you see as the most likely outcome? Do you see VIX rising and catching up with the liquidity index, or do you see the liquidity coming down?
I think these are going to come together rather slowly. I think you're going to see some move higher in VIX and move lower in liquidity risk. I don't think you're going to see like VIX just ping to 50 to 60s, excuse me, just overnight like that. I think VIX can get up to like 45, 50s, right? But it might take a while. It's not going to just ping without liquidity risk falling in. They're going to have to kind of come in and meet in the middle. That makes sense.
Okay.
Now, speaking of probable outcomes, I do think, right, that there is extreme risk that everyone obviously doesn't, either you're bearish markets or bullish markets. There's obviously extreme risk that we have these continued counter, or call it intra-regime bounces, right? Where SPY was able to go from 3,500 to 4,100 in a matter of 90 days, and now pull back. Like, this type of move gets a lot of people all in the camp that the lows are in, time to go long, right? The bear market's over, because again, people either have to be bearish or bullish. They can't be neutral. And I think that this type of environment is going to persist for a while, at least until real yields peak out. The Fed has gotten inflation under control. The risk of higher rate hikes are off the table, and we start getting the idea that peak rates are really in, and that's when the bonds will roll up and start pushing up bearish trend, pushing out of bearish trend, going into bullish trend and ripping, and that's when we're going to get some real solid direction. Now, this environment is also going to lead to a wider credit risk, I should say a wider spectrum of credit risk, meaning things like HYG have downside risk, right? Look at HYG just in the last month, we're still off the lows. Obviously, Fed pushing rates higher, like I said earlier, it's not the rate but the duration, right? We've already been at above 3% rate, 3% rate environment for a while. We're about to be in a 4% rate environment in the next few months. Or excuse me, I have that backwards. We're already in a 4% environment. I apologize. I'm thinking of something else. So we're already in a four. I'm thinking 333 basis points. Excuse me. We're already above 4%. So we're already in a 4% rate environment. And given that we are holding there, the longer we hold there, the worse it's going to get for the high yield companies that are borrowing, obviously having to pay five, they're paying 5.25 right now. Now, nothing has changed since October, right? The rate situation hasn't changed. The inflation situation is slowly getting better, but the companies still have to borrow at these costs. Obviously, growth has bounced a little bit, right? The bounce in growth, which again, the system has forecasted. We saw this coming, the bounce in growth, right? We've spoken about the risks to the upside. Those have faded. So it doesn't look like there's that much of an upside risk in growth anymore. Now, the question is, what has changed since October for high yield? Nothing, right? Except rates have gone higher in the Fed meeting. Obviously, um, long-term rates have priced a lot of this in, but it's not the again, not the face value of the bond, it's the duration. So the longer these rates stay up here, the more pressure you're going to put on these high yield companies, meaning that this can easily see new lows. This can easily go lower, and in turn will push the market as a whole to new lows as usually follows the adjusted version of this. So if we adjust this for dividends, you can see, and we do a quick overlay here. We overlay SPY. For those that have never seen this, we speak about this on Twitter sometimes. You can see that they tend to follow in suit. So if this starts breaking lower, goes to new lows, SPY will definitely print new 52-week lows, or 52-week lows, and we will see lower prices in
It
markets.
it
Now,
really it really feels like this has been very controlled so far. Does something need to break before the Fed can finally say, okay, we're done hiking. It's time to get into the cutting phase?
yeah, yeah, I think it's going to be employment. They're going to go until they crack that.
Okay,
If we
so
look
we
at
really need to start seeing damage, whereas right now we're really not seeing any damage occurring.
Yeah, let's look at continuing claims real quick while we're here. See, continuing claims are peaking. Looks like, right? They're actually lower than the prior print.
Right. So
Excuse me. These are
this
this
is
is
not what they want to see.
excuse me. Hold on. This is not updated. Let's just go to jobless claims. Sorry, I don't know why that isn't updated. United States jobless claims here. December 12th. December 12th. Yeah, no, it's not updated. I don't know why this trading view. You're slacking. Ping them on Twitter. Some bullshit. All right, we'll just look up jobless claims. Yeah, so jobless claims again aren't breaking out, right? So long story short, jobless claims aren't ripping, and like we want to see the unemployment rate go at least double, right? To give some confidence the Fed's going to start cutting. We're at 3.7. We are literally at an unemployment rate. Remember when the economy was robust, like Trump was saying unemployment lowest ever, whatever that lowest in how many years going back? Yeah, lowest since like the 69s when he was right before COVID, which it was obviously, as you can see by this chart. The economy was hot, everything was good, and then COVID hit, right? Um, well, first off, long story short, we're at that same level right now.
Yeah. So there really
So
hasn't been any improvement in that situation.
right. So the like in long story short, the unemployment situation hasn't even come off lows by more than 1%. So like if you think about what the Fed's looking at, they're going to try and break the market. They're going to want to see this at least double. You want to see this up in the sixes, up in the sevens, right? You're going to want to see this get up there to signal like, oh yeah, like man, we're we're actually people are actually unemployed. Now I know there's some statistical arbitrage or some statistical not arbitrage, but bullshit, right? Like where people are like, oh yeah, people are working double jobs, unemployed. Yeah, I understand that. But long story short, the Fed doesn't care about that. Okay. They just want to see unemployment weaken because in their minds, right, based on their Phillips curve, if you're at maximum employment, you're at maximum affordability. You can afford expensive things because everyone has a job. And like you're gonna really need that inflation to outrun you're gonna need hyperinflation at that point, right? Because you're gonna need inflation to outrun the ability for people to buy nice things because people can still look, inflation is bad, but it's not that bad. I know your people are gonna be like, a lot of people are gonna be like, what are you talking about? Inflation is bad, but your food prices aren't up 50% in a few months, right?
So you mean like the alternative inflation is bad, but hyperinflation
Oh,
is
yes,
much
exactly. That's what I'm
worse?
trying to say.
That's what you're
Right,
trying to
exactly.
say?
Like,
Yeah.
yeah, hyperinflation is much worse. And like, look, I've been, I was just at the mall earlier this week, excuse me, for doing some Christmas shopping, and the place is flooded with people. And I'm not talking about like, I'm not talking about like Macy's. I was at Saks Fifth Avenue. The place was loaded with people, and like, you would think if inflation is so bad, right? You wouldn't be able to afford to buy all these expensive clothes and goods, but people still are. And I wasn't in like New York City or something like popular. Like it was out in Long Island. But long story short, people are able to purchase things that would seem unnecessary in a recessionary environment, right? Now you're going to start to see those eventually roll over again. This goes back to it's not the rate, but the duration. The longer rates stay up, the worse things become over time. People are still able to splurge money on things, and there is such a thing as real world economic indicators that are outside of the textbook. Like you can go to stores and you can see certain things. You can see how full the mall is, compared to, again, online shopping, obviously, right? But you can see like the inventories at a mall compared to where they were last year. You can see certain things and be like, okay, there's obviously demand for this. It doesn't matter what the Fed or what anyone's saying. Like people are still able to purchase these things. Now, could it be that people are just going into debt? Yes, very possible. But long story short, um, there is always going to be a market for luxury goods. We know that. But the idea is that people are still able to go out and purchase things that they do not need. Okay. The idea is that when inflation is so bad that your food is unaffordable, you think you're going to go out to the mall and buy a bunch of shit you really don't need to live?
Right. So at the end of the day, it's not even that bad,
It's not
is
even
what
that
you're
bad.
saying. Yeah. And
I'm
so
saying, look,
the
it's bad
Fed
right
the
now.
Fed needs to hike.
The Fed needs to hike, right? The Fed needs to hike. They know it's bad, right? But it's not to the point where the Fed is going to ignore this because they are going to break the economy. Because the sum of what I was trying to say, simply put, is the Fed can go higher and not break the economy because the economy seems to be functioning just fine right now.
Right. But
A
it's
lagging,
usually
it's a lagged
sudden,
effect.
right?
Yes,
It's slow.
yes,
It
yeah.
happens slowly and then all of a sudden.
Right. But when you're looking at the Fed funds rate, right, and you're looking where we are right now, and we'll drag the terminal out of here for now. But we are not even up to where we were in 2007, right? We spoke about this. Rates are not as high. Obviously, debt to GDP, this whole nine. Yeah, I know everyone wants to fucking deplatform the Fed's ability to do their job. I understand. The Fed can move rates higher. Okay. Now, the Fed has full ability to move rates higher because it's not like they're going to 15 to 20% to fix 7% inflation. The, the Fed funds rate is not even at the inflation rate right now. So historically, we've seen this where the Fed funds rate has to pass the inflation rate to cure the inflation problem. My point of what I was saying was obviously the economic situation isn't too bad just yet where the Fed can still continue to hike rates. It's not like we're faced into a situation, right, where you have hyperinflation, right, where inflation rate is, you're talking Venezuela level shit here, and the Fed hiking interest rates is just adding fuel to the economic problems, obviously, because they have to hike rates up to 20, 30%, even higher to fix the problem at hand. And you're really just destroying everything, right? It's like it's like gasoline and fire fighting each other. And you're trying to drown the gasoline with, I was trying to drown the fire with gasoline to fix the problem, but you're just making it worse. And eventually you run out of gasoline and then the fire runs out of fuel and everything's burnt at that point, is done. But you have to, it's like an endless fight. And what ends up happening is the Fed is hiking, or excuse me, the central bank that's in a hyperinflationary environment is hiking rates so aggressively that they don't care anymore because their only goal is to control inflation. We still have a Fed that is worried about the economy. When I say 7% inflation is not that bad, that's what I mean. The Fed's primary goal is to cure inflation, but they still have a modest to strong economy or in their sales. It's not like they're facing a depression where you basically have an inflationary depression, right? Where things just go out of hand. You're talking Venezuela level shit.
All
We're
right.
not there
Right.
yet.
And
And not
hopefully we never get
Hopefully we
there.
never get there. Yeah, hopefully we never get there. But that's what I was implying. So
All
long
right.
story short, 7% CPI is shit, but it's a year-over-year figure that will fall. We pulled forward a lot of inflation. Obviously, the Fed knows that in the last couple of years. Based on COVID, we ripped forward a bunch of inflation, basically compressed into a short period of time. The Fed's going to do what they have to do to fix that problem now. And it means putting the economy into a recession, which they clearly stated they're okay with doing. They're going to do it. And I think that's where we'll leave off this podcast, and we'll see you guys later in the week with the next video.